I said I'd wait until 10:01 to give all the sleepyheads the opportunity to log in. So hopefully everybody's now engaged, and those of you that are planning to attend this morning are indeed online. So I'm just starting my stopwatch there. My name is Mark Solon. I'm the managing director of a company called Symmetry Financial Management. We are a small independent financial brokerage. We're based out in Dunboyne. We have a national remit, as in we have a coverage for the entire country. We deal with quite a number of the trade unions, and we do quite a lot of financial education, which is why I'm here this morning with Umbrella Wellness. So we're a new enough a company in that we only became regulated in 2018, June 2018. So the 2-year birthday was in the summer there. We had a COVID social distanced party with staff. As part of the company I was involved with before, where I was also a director and founder, we were the Money Mate mortgage broker of the year. And basically, when the split happened, we took all the staff over with us to Symmetry Financial, and we continued on the journey with the mortgage advice process and mortgage advice sector. We've 8 staff, and we're in the process of hiring more. So hopefully everyone can see that slides and that slideshow at the moment. So if there's any questions, obviously you can put them up on the chat. I actually, just to comment on that, I see Dylan has already just put up a link on the chat box there for Umbrella Wellness, with a link to request information or to make an appointment with us if you would like to take your knowledge further and arrange a one-on-one or a one-to-one with myself or one of my staff to understand how everything I'm going to cover is relevant for you. Okay, so there's quite a lot in this morning, so we're going to scoot down through roughly what we're going to try and cover. I'll focus on more elements, some elements more than the rest. But basically just going to look at mortgages as an introduction. There's loads of different types of mortgages: first-time buyers, second and subsequent buyers, equity release mortgages, investor mortgages, renovation mortgages, self-build mortgages, debt consolidation mortgages, to name a few. So while you might assume that a mortgage is a mortgage, in fact, what actually is going on under the hood is completely different depending on the product that you're looking to avail of. Going to look at how much you can borrow, going to look at the different lenders, how long you should borrow for, what type of product you should opt for. If you already have a mortgage, is there a benefit in switching, and how you can potentially save money over the duration of a mortgage. So quite a bit to go through. I'm assuming some of you may have heard this seminar before. I have changed it a little bit based on just keeping things fresh, and obviously what's going on in the market at any particular time. So to give a summary of what's actually going on, I'm going to look at 2020 year to date, and I don't mean this in context of the American election. I mean this in context of Ireland, the property market, and the impact of COVID-19. When we had unemployment at the end of the first wave, we had unemployment as high as 30%. Now we're into our second lockdown process, and obviously unemployment isn't as high because of the relevant or the various government supports that have been put in place. But without those government supports, the unemployment rates would skyrocket. I was only looking yesterday, last night actually, on the revenue website, where they're now listing all the companies that are availing of this new EWSS, the employer wage subsidy scheme, and there are over 60,000 companies availing of that. Now they could be one man, one woman employers, or companies up to obviously the SME level. So it's not an insignificant number of people surviving on the EWSS. So what happened in Q3? So Q3 brings us up to the end of September. Property had pulled back at the end of Q2. Obviously would have been expected, COVID having an impact on the market. But what happened in Q3 wasn't necessarily predicted by any of the analysts out there, in that property prices rebounded and recovered as we got to grips with this COVID pandemic and what it meant to live with it as opposed to survive with it. So property prices across the country increased on average quarter on quarter, And when we look at it in the bigger context, year on year, which I'm going to break down now in a second, property prices increased. But June to September, there was a significant increase across all geographics within the country, with an average of 5.8% around the country. The 4 cities outside of Dublin, 9.8%, and then Dublin itself, just under 3%. So that's not, those increases aren't to be sneezed at. Now they are coming off a drop in property prices at the end of May, but it's still, again, it's still significant numbers to bear in mind, especially if you are looking at investing in property. So why is this happening? Again, you'll read it in the paper every day of the week. It was the foundation, or the basis of the budget, which was 2 weeks ago at this stage, and it all comes down to supply of property, or supply of product, and there's not enough of it out there. A lot of these figures will come from DAFT and from the various housing associations. We are at an all-time low. We're at a 14-year low, which for the majority of us will cover most of our working careers to date. So there's not a 14-year low in terms of stock available for people interested in buying property. In terms of prices, so this is the year-on-year figures. So again, not going to zone in on it. The slides will be made available to you afterwards, but the numbers that jump out for me, and so I have it on a big screen here beside me, the numbers that jump out for me would be every county and every area had an increase, with the exception of 4 to 5. Clare is the only one that had any real significant decrease. Everywhere else was more or less flat, or were in green. Okay, so a couple of small decrease, negative figures there, but that gives you an idea. Year on year, property prices around the country are still on the up. Okay, so when you break that down per territory, again, very quickly, Dublin, you can see there the quarter on quarter, year on year, and then the change from the trough. So what that basically means is when property was at the bottom of the market back in 2013, where it's at now, how much it's increased in value since then. So if you were lucky enough that you were able to get your hands on a property back in 2013, you've done very well if you bought in the Dublin city area. In relation to Leinster, again, it's similar figures been reflected across the board. As you can see there, supply numbers are down everywhere. Just there's not enough property out there to satisfy the number of people looking to carry out the transactions. Okay, Munster, again, very similar, and then Connacht Ulster, again, very similar. Okay, so that gives you a snapshot of where we're at in the country. So getting into the nitty-gritty of the actual presentation then, and rolling up our sleeves. So it's explaining what a mortgage is. So again, I'm not going to read that out line by line, but ultimately what happens is when you take out a mortgage, it's a loan that's secured against the asset that you're buying. So if I'm buying an apartment, or I'm buying a house in Drumcondra, or in Glasnevin, or in Kildare, or wherever, Wicklow, I'm buying a house. And I'm using a mortgage to buy that asset. Once the transaction is done through the conveyancing process, which is the legal process, the title of that property moves from the people I'm buying it from via my solicitor to the bank that's lending me the money. So the bank hold on to the title or the deed of that property until I have paid off that mortgage. So they use that as their collateral or as their security. Hopefully everyone is aware of that one element. That's basically, in its essence, that is what a mortgage is. In relation to how they're structured and how they work different than most loans, in that the secret language for a mortgage is what's called amortization. So if I can bring over this presentation, or this spreadsheet, it will explain it to you in much better language than me trying to put it into words. So if we have a loan of 250,000 euros and we're going to borrow that loan over a 30-year period, what's basically going to happen, so can I zoom out on this a little bit so you can see a little bit more of it? What's basically going to happen is I'm going to pay that mortgage off over the 30 years. It's going to cost me 987 euros a month. Let's say the property I'm buying is 300,000. On top of that, I'm going to have to pay property tax, house insurance, and life insurance. So estimated figures there on that mortgage, including the additional costs, it's going to cost me about 1,100 quid a month. So don't forget to include the additional costs. But what's actually happening underneath the hood is I'm paying off that mortgage with interest and with capital. So that's the bit that's reducing the loan. So my loan starts at 250. I'm paying just under 1,000 a month. Of that, 460, the first month, 466 of it is capital, and the balance is interest. So this is where the bank make their money. and this is where my capital reduces. So at the end of year one, if you've never bought a house, or if you have been through this before, then you'll know that the mortgage loan that you owe doesn't reduce that quickly. It can often seem like it takes years before there's any major indentation in the loan that you owe, or the balance of the loan that you owe, and that's because of amortization, and it's the way the loan is structured, with the interest charged, the majority of the interest charged in the earlier years. And just to show that as an example, again, if you listened in before, this is again a 250,000 euro loan over 30 years. In the first year, I'm going to pay just over 6,185 euros in interest. Okay, so that's a significant amount of money that the bank are going to make from me. And if I then go to the, I went too far there. If I then go to the last year, so the 30th year, I am going to pay 159 euros worth of interest to the bank. So the majority of my payment in the last year is going to be capital, whereas the majority of the payment in the first year is going to be interest. So the bank are making money on me more so in the early years and less so in the latter years. So they generally will not incentivize you or encourage you to pay lumps off that mortgage, even though that's the way that you can win against the banks. So to put that into context, if I have a mortgage of 250,000, and let's say every 24 months, so that represents monthly periods. So if every 24 months, or let's go every 12 months to keep it simple here, if every 12 months I decided I wanted to pay a little bit extra, so I money accumulating in my savings account, which we know right now is getting nothing. If you're lucky enough to have enough money, and that figure is over 2.5 million, you probably wouldn't be listening to me. The banks now are actually passing on the negative interest rates to their clients. So those with larger balance sheets or bank accounts are actually seeing negative interest rates on their current accounts and savings accounts with the banks. But just to show you how this would work, if I was paying that loan off a little bit extra, so let's just say an extra 1,000 euros, and I did that every year, that 1,000 euros, so it would mean I'd pay an extra 26,000 euros over the duration, which is going to save me about 12,400 in interest, which will bring the 30 years down to just under 27 years. So something very simple can take almost 3 years off my loan by purely paying a little bit extra to the bank. If you were to look at it a little bit differently, you might want to pay it every year, but let's say every 5 years you pay a chunk off. So let's say every 5 years you paid 10 grand off. Okay, that 10 grand, for example, so you'd make 4 payments of 10,000 is approximately what you would be, what's calculated here. You'd be saving just under 20,000 euros or 19,000 euros in interest, which is money that you don't end up paying to the bank, and you'd have taken 5 years off your term. Okay, so it's not too extreme. The way we generally try and encourage people is if they can overpay it regularly, or even every year or every 2 years with an additional payment, the future you will thank you for doing so. You don't necessarily see the benefit, but you'll notice it obviously because you'll be mortgage free at 55 as opposed to at 60. Okay. Now, what is really important in all of this is so let me just change that to 12 so I can show you. If you do decide to pay off any chunks of money off your mortgage, what's really important is if I pay a lump off, so that 10 grand has gone off as an extra payment, it's important that when you make that payment, it comes off the capital amount and it doesn't impact on your monthly repayment, so that the bank don't come along and reduce your monthly repayment down to 940 euros a month or 950 euros a month, because that's taking away the benefit of you making that additional payment. All they're doing there is they're going to reduce your monthly. In that example, they would just reduce the monthly principal paid to counteract the 10,000 that you've paid in. So it's really important that you get this right. And it actually came up in a seminar I did last night where one of the questions came in. They've been trying to do this with one of their banks. We won't mention the bank. And the bank have said that if they make the lump sum payment, it's going to reduce their monthly repayment, which isn't accurate. You can make extra payments off a mortgage and it doesn't have to impact on the payment amount that you make on that mortgage. So you can still pay your 987 euros a month if you make lump sum payments, but it's just the way the banks work. It's extremely lucrative for them to have mortgages over the maximum term, which most banks will look for the 35 years. Okay, so where do you start if you are looking at mortgages? I'm going to cover all types of mortgages here, by the way. Again, some feedback from the last sessions is not everybody's a first-time buyer. Some people are in different positions. So the question obviously is, are all mortgages the same? And it's very simply, they're not. I kind of touched on it at the outset. you have your first time buyer, which is completely different product than your second and subsequent buyer. And it's different again if you have a property and you're looking to avail of an equity release, or you're looking to switch your existing mortgage. Are you looking to move? Are you looking to renovate the home you're in? Are you looking to buy a property and renovate the house that you're buying? So all of these are options. Are you looking to build your own home? So when you're looking at a mortgage for a principal dwelling home, so a PDH, a principal dwelling home, if you're looking at those mortgages, there's different variations of those mortgages before we actually look at the different products that are out there. Okay, so different angles on it. And again, one of the sessions last week or the week before, we explained a renovation mortgage to one of the clients, and they'd never were aware, hadn't been made aware of it by one of the mainstream high street banks. And it basically means that they can go and buy the property that they now want to buy and do it up the way they want to do it, and not have to kick the can down the road because of the way the renovation mortgage would benefit them. Okay, your term is based on the different banks, so it's 65 up to 70. It varies from bank to bank how long you can borrow for. The maximum term will be 35 years. There aren't any 40-year mortgages, thank God, but there are 35-year mortgages. So if you're 30 years of age and you're taking out a mortgage, you could go to 65. If you're 35 years of age and you're taking out a mortgage, subject to which bank you apply to, you could go up to age 70. The first test you have to adhere to is what's called the repayment ability test. So demonstrated repayment ability, or can you afford to pay me, as in the bank, this mortgage? What that basically will be covered by is your savings history, and if you're paying rent on via direct debit or standing order. If you're paying rent by cash, which some people do, you need to have a rent book, and you need to be taking that money out as cash at the same time every month, so that there's a track record of it. If you're paying money to your parents because you're living at home, again, you can get around that being calculated as rent if you don't call it mammy or daddy, or paying money to parents. If you call it rent, the bank, you don't necessarily have to tell the bank that you're paying your parents, because some banks won't accept repayment ability from a child to a parent, because the parent, in the eyes of the bank, could be giving you that money back the next day in cash. Okay, so just little things to bear in mind there and how you work around them. If you or your spouse have variable income, if you're self-employed or your spouse is self-employed, if you work in the public sector or the private sector, again, all of these things impact how much you can and how much you cannot borrow. For example, in the public sector, just to take a snapshot there, the public sector, we can use 2 points on the salary scale above what the individual is earning. So to give, again, a real life example we have here this week, I think it was a nurse, she's on 48,000. We can go 2 points up her scale to 52,000. That was basically the salary we're submitting the mortgage on, because a couple of banks will allow us to do that, and they will accept that for her income, which means ultimately she can potentially borrow more. Okay, variable income covers things like bonuses, commissions, allowances, shift work. So again, it varies from employer to employer how much of that you will be able to qualify for your mortgage, and some towards your income for your mortgage. And some banks are way more draconian on this than others. Okay, so just because one bank, and we had it, I'll give you a perfect example. Actually, I have going on at the moment. 2 brothers, believe it or not, one applied to Bank of Ireland with us directly, and one applied for Bank of Ireland. Sorry, one applied through Bank of Ireland to Bank of Ireland through us, and one applied directly. Okay, the guy who applied through us, and they're both in the same job. They both came to Ireland at the same time. The guy who applied to us, we got him approved for 245, and this is no lie, 245,000. The guy who went directly to the bank, he came to us after he got approval for 148,000. So I rest my case in terms of why you may avail of a broker as opposed to a bank directly, in that the bank don't really, unfortunately, and again, it's not a tar on the brand, on the bank individuals, it's just the way banks operate. They don't really care. It's all about getting the numbers. So it's targets to get applications in the door, and then you have your funnel, and enough of the products or enough of the applications ultimately come out at the bottom. Whereas the likes of a broker, we work on a different model. We work to the beat of, if we put 90 cases in, 100 cases in the funnel, we want 90 of them coming out the bottom. We can't operate on the basis that if we put 100 in, 40 of them come out. That's just not feasible for us. Every independent broker would have to close up shop if they operated like that. Self-employed, I touched on there. If you're self-employed, you're needing 2 year sets of accounts, up to 3 year sets of accounts, depending on the bank. Again, it's very onerous. A lot of documentation required for self-employed. I love dealing with self-employed because ultimately you deal with the accountant. So it's the accountant where the individual needs to get involved and get on board. They're the ones that are going to provide the information to support your case. How much have you saved, which makes up your deposit? So again, it'll vary. We get to that in a second. And do you have loans? And if you have loans, how do they impact on your borrowing capacity? So you are limited how much money you can borrow and pay back. Okay. And then lastly, sorry, I threw this in again because there was a question last night. Can you qualify, or do you qualify for an exception or an exemption case? And there's two types of those. There's loan to incomes and loan to values. Again, I'm not going to touch on that too much today. So if you're looking at investing, so just skipping through this very quickly, I don't know if it'll be relevant. If it is actually relevant for anybody in listening this morning, if you put it in the chat box, or even do it privately to me if you want, just saying it is relevant. If it's not, then I can skip through a lot of the slides later on. Okay, so just to kind of touch on it. You can invest and buy property as an individual, via a company, or through a pension scheme. And if you're doing it through a pension scheme, there's different types of pension schemes that you can avail of to invest in property. The borrowing age, if you're investing, is again up to it's actually different. It's up to age 75. The max term is 35. When it comes to pension, the max borrowing term for pensions is 15 years. So you can get out the gap on a pension property, as they call it, very, very quickly by paying off the debt. Okay. And the difference in demonstrating repayment ability for an investment is the rent. So the rent is what we use to ensure or identify whether or not this property is going to pass. If the rent isn't high enough, then the property isn't going to be accessible or approved by the relevant lender. It's all about the property and the rental. Whereas if you're buying that property to live in, it's all about you and your income. So two totally different approaches to what most people will say is the same thing. Okay. Moving on, so how do you get your deposit together? So there's different ways you can get the deposit together for an investment if you already own property. There's different approaches to it if you're employed, self-employed, or retired. Again, I touched on that already. And then the impact of other loans. When it comes to investments, you do have the option to pay interest only. Wouldn't be recommending it. What that basically means is, going back to the calculator I showed you a while ago, is you'd only pay the interest column. You would never pay any capital. So you might be asking, why would you do that? I would agree with you. Why would you do it? But some investors do it to keep cash flow to a maximum so that they can go and invest again. But it's in my mind, it's not good long-term financial planning. I've already touched on rent. Investing in property is all about the rent. There is actually nothing else to it. What is my yield? How much? So basically, how much am I going to earn as a percentage on the property? So just to give an example there, if I buy an asset for 100,000 euros and I rent that for 10,000 euros a year, then I'm getting a 10% yield. That's as complicated as it is, and you need to make sure that your yield is at least over 8%. And then how you can let that property, you can look after it yourself, you can use HAP, or you can use social housing. So there's different elements in terms of how you can go about renting that property and maximizing the return on your money. So again, investing in property would make up part of a retirement plan. Okay, that's why you would do it. Okay. In relation to brokers, I've already touched on how you go about applying. If you've applied to a bank and you've got your approval, listen, don't panic. It doesn't mean you have to use that bank. You can go through brokers. Most brokers should be a one-stop shop, and they should be able to take you through all the different elements and the different rules that apply to the different banks. They all have their own rules, which makes it extremely complicated. Rates will vary. Fixed versus variable is always an ongoing debate. And then the term that you avail of for that loan will dictate how much interest you pay back. So while the monthly repayment will be higher for a shorter term, the interest will also be lower. Okay. And then you have the other big debate that we have with clients pretty much every day, which is in relation to the cashback incentives out there. So do you avail of cashback, or do you go for the better interest rate? There isn't a right or wrong. Well, there is a right or wrong answer on it, pardon me, but it comes down to what is right for you at that time. So there's no point in me talking somebody out of the cashback incentive if after they do the deal and they can afford to pay, let's say they can afford to pay 1,100 a month as opposed to 1,000 a month with another bank, because they're paying rent at the moment of 1,300 quid a month. but they buy the property, they don't have any money to furnish it. So the cashback incentive there will give them a few grand to maybe put in furniture. You know, it would be folly of an advisor to say that the cashback incentive is a bad idea in that example. However, if you've got more than enough of a deposit, do you need that cashback incentive? And then lastly, which this applies to every single mortgage out there, with the exception of your pension product, what is your credit history? So how have you treated debt in the past, and what do the banks see when they look at your credit report? There's two credit systems. There's the ICB and there's the Central Credit Register. So the ICB is icb.ie, and the Central Credit Register, it's a bit more of a mouthful in that it is, where have I got it there? It is centralcreditregister.ie. We have a step-by-step guide as to how you go about ordering your Central Credit Register report, which is really the report that's now dictates borrowing capacity in the industry. The ICB was the industry solution to debt history, your history in terms of debt repayment, whereas the Central Credit Register is the regulator solution to it, which is much more efficient. It's a much more efficient tool. And again, I'll give you an example this week and last week for an application we're looking after, where a client has a loan going back to 2009, 2010. They left Ireland, emigrated at the end of the last recession, went to Australia, came back in 2015, 2016, set up their own company, weren't aware and just buried their head in the sand in relation to the loan. They didn't get back to the bank, so the bank didn't do anything about it. Lo and behold, she didn't discuss it or mention it to us because it's 10 years ago. She assumed it was written off, and we're applying for a mortgage and it's the first thing that pops up. So unfortunately, that individual is not going to be able to borrow. Okay, there is a process she'll have to follow. She and him, her and him will have to follow to be able to borrow into the future, and we will guide them on that as well. But they're not going to be, and they're bidding on a house at the moment, so that basically means that their immediate dream has just been somewhat crushed. So it's understanding the impact of your history with credit. It's really, really important, and it comes up all the time. What else is relevant then? A few tips in relation to applying. So getting approval in principle in advance is good advice. So I'm not just saying that because you're going to come to the likes of us for the AIP. It's that you know what you can borrow. Now, if after a 15-20 minute conversation with most people, I can tell what you'd be able to borrow, and it'll vary from bank to bank. So, and I gave you the Intel example there already, which is as extreme an example as I can give. But approval in principle is basically the document that all estate agents will look for when you're successful on the bid. And right now, because of the second lockdown, it's the document that all estate agents are requesting that you have before they'll even accept a bid off you. So this is new. This isn't something that was there 3-4 weeks ago. Because of lockdown number 2, we're seeing every estate agent is asking for AIP before they'll accept the bid from the interested individual. Okay, you don't panic. There's loads of options out there. Just because you have approval from one bank doesn't mean you can't shop around and go elsewhere. And again, I mentioned look at rates as opposed to the incentives, but understanding why you might look at the incentives. Okay, and then the tool that will be very useful for you to compare, and we use this with clients, is the CCPC calculator. So where you log on to the Competition and Consumer Protection Commission, they have a very, very detailed mortgage comparison tool there. When we were building our current version of our website, the web development company were talking about creating a tool, and my answer to that was, let's put a basic tool in there, because there's no point in us trying to replicate what is already out there, and it's the best tool on the market by a mile, and it's run by a government agency. Okay, it's not relevant for investments, so I do have that in italic there. It's not applicable for investors, but it is applicable for every other type of mortgage. So if you are a first-time buyer and you're looking to, and obviously the purchase price isn't necessarily going to be 100,000 after everything I've gone through, it's just that you'll understand the concept. If you are buying a property for 100,000, the deposit's 10%, the mortgage is 90, so that's 90%. Stamp duty, legal fees, outlay, total costs will be 103,750. The only thing there that should be variable is if you're buying a house for 400,000, is obviously your deposit would be 10% of 400, which would be 40. The stamp duty would be 4, which is 1%. Legal fees and outlay shouldn't change dramatically. if you're buying a property for 4 times this value. But unfortunately, you do see clients getting quotes or clients paying significantly more for legal fees when they're buying higher value properties. And that's not the way it should be. It should be a fixed fee for the conveyancing element of the purchase. But that is not how it always works out. And again, an example I gave at the seminar, the last seminar I did, our webinar I did, was a solicitor we were speaking to about 2 weeks ago, looking to get an idea how much they would quote for a client buying a property in a particular area. And he wasn't able to give us a figure because he needed to get the information in advance. So basically what that means is he's looking to see how big a loan they're borrowing. So if instead of 100,000 it was $1 million, then obviously his fees are going to be higher than if there was a lower loan, which isn't really the way it should be, because the property purchase process is the same no matter what. Okay. If you're a second and subsequent buyer, it's again, that deposit is 20,000. I have in there minimum 10. That's if you qualified for a loan to value exception. So if you qualified for what the banks call the central bank calls a loan to value exception, you could get away with the 10,000, in which case you borrowed the 90 or the 90,000, but it is 20,000 in a typical purchase for a second and subsequent buyer, equity release, self-build, switcher, etc. You're literally looking at that 80% loan to value, legal fees, etc. Okay. So I'm not going to get into investment. No one has commented on it, so we'll keep it moving through that. How much you can borrow for a first-time buyer is 90% of the property, which means you need the 10%. So on a 300,000 property, you need the 30k deposit, which we've mentioned already. Help to Buy could come in here for the first-time buyer, in that if you are buying a new home, you can now get up to 30,000 euros assistance if you've paid enough tax over the last 4 years, and that's the Help to Buy concept. I have in there the 31st of December 2020. They've suggested in the budget that that's going to be extended to December 2021, and that will come out in the Finance Act, which will be over the coming weeks. So it is due to extend into 2021 as per budget, but that's again, it's down to the Finance Act, which is just rubber stamping the budget. Okay. Other than that, what's important on Help to Buy is it's a maximum purchase price or a value of 500,000 and a maximum loan to value of 70%. So that can sometimes cause problems if you are looking to build your own home. Okay, so just to be careful on that. Second and subsequent buyers is 80%, which on a 300 grand purchase will be a 60,000 euro deposit. Okay, so we'll skip down through the pension and investments. How much you can borrow is based on 3.5 times your salary, plus if you're applying with your partner, their salary, partner or wife. So if my salary is 40,000 and my wife or partner is 60,000, combined it's 100, we can borrow 3.5 times. If we qualify for a loan to income exception, this is where it would kick in. So we could, in theory, borrow more than the 3.5 multiple. There's no cap on this figure here. Despite what people will read, some places you'll see it's a cap of 4.5. That's the bank cap of 4.5 or the bank cap of 4, but there isn't any actual cap. You can borrow, you could potentially qualify for 4.57 times your combined salary. It's down to the calculator from the bank and how they're assessing those particular cases at that time. Okay, so and that changes. Again, we only got new calculators out for PTSB, using them as an example, on Monday. So we have new calculators for PTSB, which means the calculator we had on Friday is now redundant. So it's different formula, different calculations going on behind the screen. Okay. The different types of the deposits then, again, it'll vary depending on the purchase price and whether you're a first time, second and subsequent, or an investor. So that's the 10, the 20 and the 30% deposits. Okay. Again, explaining what we've touched on with the calculator, the importance of being aware of term. So if I take that 25-year versus the 35-year term as an example, and just pick the middle one there, the 315,000 euro loan, if I went for the 25-year term, I'm going to pay just under 300 euros a month more than if I went for the 35. So I might be more attracted to the 35-year term because it's keeping my repayments down. Great. But if I take that approach, I'm going to pay an extra 50,000 euros in interest over that 35 years. So those extra 10 years costs me 50 grand in interest, basically. So just to highlight what that means. And if you take it as 49,024, if you take it as that figure, that's not something you can pay out of your net, your gross salary. You pay this out of, mortgages are paid out of your net take-home pay, paid out of your net salary. So 49,000 in net salary is generally in and around 100,000 in earned income. So between you and your partner, your wife or your husband, you're going to have to contribute over that 35-year period an extra 100 grand of your salary to pay off that loan, to pay that loan, even though it's a lower monthly repayment. Okay. What's investing in property via pension? So I'm not going to touch on that. Disadvantages. So which bank should you or should you not consider? So you have all the different banks up there. I've thrown them all in there. What's happened in the last month, we've had Avant mortgages enter the market. We've been asked about Avant probably about 24 times already. Avant are very, very, very specific in relation to the mortgages that they're looking to take on board. They're ideally looking for the lower loan to values. They've got a great rate there at the 60% and below loan to value. The rate is 1.95, which is the best in the market. But they really are looking for the juicy business at the moment. But it's great to have a player entering the market, bringing a bit of competition. However, you will see that none of the other banks have responded to Avant mortgages rates because they don't have to. And that tells you all you need to know. And it's not been disingenuous to Avant mortgages. I'm delighted they're in. I am hopeful that they'll be successful and they'll bring a bit of competition to the larger scheme. But because they're so niche and so specific at the moment, they're not looking for huge volumes of business because they can't take it on board. This is really their first 6 to 12 months will be dipping their toes in the market, learning how it works, and building from there. Hopefully that will have a positive impact in rates going forward. But Bank of Ireland, PTSB, Ulster Bank, EBS, KBC, Finance Ireland, ICS, none of them have reduced their rates as a result of Avant mortgages, which tells you all you need to know. Okay. This is a copy or a screenshot of all of the mortgages that are out there. So every tab is a specific mortgage, believe it or not, which might be a little bit scary, but in relation to how you choose, I have no idea if you were going directly to a bank how you would choose, and ultimately you don't. The bank tell you what to do. That's ultimately how a mortgage is sold. You go into Bank of Ireland or AIB and they tell you which product to take. That's basically it. And you're happy with that and you're comfortable with that, then at least it's buyer beware, so you're aware of the process. But my advice and our approach is always educate yourself first, know what your options are, and then make an informed decision. So at the end of that, and just to use the 2 I've circled there and 3 I've circled there, if I opt for Bank of Ireland at 3% and not KBC at 2.35 or Avant at 2.35, I know I'm making that decision based on an informed choice because I want the 2% cash back and a deferred start, potentially a deferred start from Bank of Ireland. So you make that informed decision as opposed to being sold the product. Okay, hopefully that's clear for everyone. Okay. I believe there's a question after coming in there. You're interested in information about a second mortgage, how to apply, where to start in general. Is there a good idea? The good idea is a way to buy a second property. Will you send that Excel at the end, please? The Excel we don't share, unfortunately, so that's our own proprietary calculator. Happy to use it with the individual that's asked the question if they want to contact me at the end of the presentation, and we'll send you through different variations of it. It's just it is our own proprietary little calculator. There's a fantastic app out there called Carl's Mortgages. I found it when I was considering creating our own mortgage calculator app, and then Carl's Mortgages appeared, and I have it on my own phone, which is a great little tool for those of you that want to get a mortgage calculator. But in relation to buying your second mortgage, I have touched on some of the elements there in relation to the deposit, the loan to value exception, maybe what you're looking at, if you own your own home, are you selling? So these are questions obviously you can't answer. I can't answer without going through the examples, but questions I would be asking: do you plan to sell? Do you need to sell? Do you want to hold on to your existing home, rent it out for retirement planning in the future? Is there equity in the existing property that you can use to give you the deposit for your new home? Have you got the deposit already? Do you need the loan to value exception? Your income's obviously supporting the loan. If you sell or if you retain the mortgage, how does that impact your new application? So there's many different angles on that, but absolutely I'd be more than happy, whoever put that question to us, I'd be more than happy to take you through that if you wish. Okay. So using an example then of the different calculators, I think we're okay for time just yet. I am going to open I've no preference in relation to which bank we go to, but let's just use PTSB because they are easier for individuals to follow what's going on. So I'm just opening it up here. There's a lot of macros in behind, so I just have to let it load, and then I'm going to drag it over. Okay, so and while I'm waiting for that to happen, here we are now. Okay, so I haven't pre-populated this, so John and Mary, and let's say John is 35 and Mary is 34, and how many in the household? So will we say John and Mary are a partner with no kids? Yes, just for now. If you have kids, they'll go in there. Their ages will go in there. So if they had a 12-year-old or if they had a 2-year-old, they'd go in there. Okay, and that will impact here because then the number in the household will go to 4. If they have child-minded costs, that again eats into their affordability. Okay, so how much do they want to borrow? Let's just say they want to borrow 300,000, and their term, let's just say, is 30 years. And they're buying a house for, let's say, 360,000. Okay, so let's say they've got the deposit together. So are they a first-time buyer or a second-time buyer? So see there, if you're a second-time buyer, it's saying that you, unless you're a switcher, which is outside of the central bank rules, you don't have enough loan to value. So put in first-time buyer, we're fine. Second-time buyer is where the issue will crop up. Okay. Again, that's a loan to value exception. Calculator, so how many years do you want to go for? 2 years, 3 years? So the best product with PTSB is actually their 80% loan to value product, which in this example we're not going to just yet. And then is it a self build or not? If it's a self build, then we've different information to include, which will say it's not. A straight switcher, if it is a switcher, yes or no. And let's say that they're proven repayment ability because they're paying 1,400 euros in rent, and they might even be saving £1,000 a month. Okay, so yeah, down in here. So are they married or are they single? So it's a joint application. So if they're single, then they're being taxed behind the scene as two single individuals. If they're married and there's a benefit into the system to tax them, for example, if one was earning 60,000 and one was earning 20,000, that would benefit the individuals behind the scene in terms of their net affordability. But let's just say 50,000, and will we say 50,000 euros as well? Okay, so do we have overtime, bonuses, commission, other income? So again, just to show you what I'm talking about with PTSB. So let's say your overtime is 2,000 a year. We're taking 1,000 of it. If we say the bonus is 5,000 a year, or potentially 5,000 a year, we're getting 2.5 of it. If you have demonstrated a 3 or more year term with that particular payment, we can argue to get the full amount of it counted, in which case it will go in there under other income, which is the scenario I gave earlier with Intel. Most of it would have fallen in under other income. So what's happening then as we scroll down? So very clearly, the loan to income ratio is under 3.5. So they're 3, what's called their net score. So that's basically how much of their overall income is allowed to go towards debt. It's 47.5% based on their income. So this figure here can be as low as 40 and as high as, I think it goes as high as 50, definitely 47.5. And in this case, they're at 28.9. And in relation to their minimum disposable income, they've no kids. So their MDIR, minimum disposable income, is 219% of this figure here. So they clearly pass. If we were just to skew it a little bit, if we were to throw in that between them, they've got 2 car loans costing £1,000 a month. So we can see that the 38% or the 28% has jumped to 45. So they don't have much capacity for more debt, and their MDIR is still well within the remit. But it has dropped significantly to just under 170%. So that's what debt does. But if one of those individuals was earning 40,000. There we go. So it actually has the outcome I was looking for there. So we're still in under the loan to income requirement. We're fine. The net score, we're now just over the net score, but their MDIR. So in this example here with PTSB, they wouldn't get a loan because they've too much debt. There you go. That's basically one example using one very quick run through in relation to how external debt can impact. And it's the same thing here. If I was to include an extra child here, as 2, for example. And again, every bank does it a little bit differently in terms of the calculator. Permanent TSBs is the best bank to actually talk you through it. So if I say there's no child minded because granny is helping out, they have a 2-year-old. Again, while they failed down here before, you can see the MDAR has dropped significantly. So it's gone down to 125. So if we take the loan, so let's say the loan was 800 a month, it should get us over the line. There we go. So we're now passing there, okay? But in terms of the overall strength of that case, these clients wouldn't qualify for a loan to income exception or a loan to value exception, whereas the very first example I gave, they would qualify for a loan to income or a loan to value exception. And that's based on the percentages that they have to have on the calculator at the time of application. So to put it into context, this percentage has to be a particular figure, and this has to be a particular figure for permanent TSB to approve a loan to income or a loan to value exception. Other banks do it differently. Hopefully you found that useful to see how one simple calculator from one particular bank can have numerous different permutations and how it can impact the loan process to be successful or otherwise. Okay. So where are we then? We're back in here. So that was me just taking a look at one calculator. The KBC, I'm not going to do it because at time we're heading towards the end. So in relation to the likes of Symmetry and other brokers, I'm obviously here talking about my own company, which you will understand. A good broker represents you. They don't represent the bank. So it's our job to get your case in the right manner to ensure that you're going to be successful and get the house that you want, and doing it with as little amount of stress throughout the process as possible. They should be able to deal with all the banks and know what the banks have on offer. A lot of our time is actually spent on run-bys. So we get a scenario from the bank and we take that scenario to the different banks to find out which bank will accept it. So before the individual has signed an application, they know where they're applying. We operate like this on a Zoom scenario, face-to-face when it's possible. In terms of remuneration, we're paid by the bank that you borrow from, and all the banks pay brokers 1% of the mortgage. Some brokers will charge a fee for the process. We operate a little bit differently in that our modus operandi is, if you like how we operate, will you refer us to your friends? And that's basically been our business model in the previous business and in this existing business, and it's worked very well for us. We have deals with different providers and solicitors and insurance companies, and an example there of our partners. We have deals with solicitors, builders, painters, landscapers, cleaning companies, tax companies, people that would clean your outside of your house, people that clean inside your house. You want to put new bathrooms in, we've got deals with different or arrangements with different providers to try and get you the best options out there. And bearing in mind, sometimes it's hard to get these people to come back. Okay. The last thing there, I skipped over it. The last thing there is life cover. Again, it's quite a busy slide, but what I'm trying to explain there is, again, it's another benefit of the broker market, or it should be a benefit. I can't say it definitely is, because not every broker is doing it right. So what you should be looking for is a comparison sheet on all the products. So this is an example. We pay for this. So it's one company versus the other. So in this case, New Ireland is 144 a month. Zurich is 95 a month. The exact same product. Exact same cover. In fact, if you wanted to get nitty gritty, Zurich's cover is better than New Ireland's cover in this particular example. Yes, New Ireland feel they're okay to charge €50 a month extra. The reason for that is because New Ireland do their business through Bank of Ireland Life, which is Bank of Ireland. So if you take a mortgage out directly with Bank of Ireland on your own, you will deal with New Ireland or Bank of Ireland Life for your insurance, unless you shop around. If you deal with any of the other banks, which I mentioned already, they're all linked with Irish Life. So again, if you go directly to a bank outside of Bank of Ireland, you're looking at Irish Life. Agent will be selling you the life cover, and you can see they're the second most expensive. And the last point I'll make on this is, not only is that price €95 versus 127 or 144, in fact, that 95, we get an additional 10% reduction on that, which we pass on to our client, which would bring this case down to €86 a month. So it would actually be 86 versus 144 or 127. So again, it pays to shop around. Okay. So if it is something that you want to follow up on, one more question which I'll answer now in a second. If it is something you would like to follow up on, roll up your sleeves and understand how this is going to work for you, please reach out to us. So the website is very simple. It's Symmetry Financial Thankfully, the name wasn't taken when we were getting regulated. You can book a consultation on our website. You can schedule an appointment. You can email us at info@. Dylan has kindly put up a link on the chat box there if you want to access it before we log off this presentation today. I believe there's a little tab in there as well. And my personal details then go up at the end. mark@symmetryfinancial.ie or info@symmetryfinancial, and then there's my mobile number as well. We will disseminate the slides to those of you that are listening, and hopefully you found it useful. There's one last question that came in about BIK and non-cash bonuses such as gift card vouchers. Gift cards and vouchers, no, because they tend to be a way for the company to give you tax-free benefits again under revenue limits, and it tends to be €500 a year that a company can give its employee tax-free. BIK, however, is as admissible, and it's BIK in relation to health insurance. Dental insurance tends to be where you have the BIK-able events, and if you have BIK on some of those payments, we can include that with some of the banks, but not with every bank. Again, it just varies from bank to bank. I touched on the self-employed earlier. The rules around how self-employed income is totally different from one bank to the other. It bamboozles people when you're explaining that one bank is going to give you an accessible salary of, and I'll give you a mental example. We're doing a deal in Galway at the moment. They're buying a fabulous house, 750,000, successful business, but he's only trading 2 years. One bank will give him an income, and I'm not lying, of €10,000. The wife, thankfully, has a very, very good job in the pharmaceutical industry. She's on about 120,000 a year. One bank will assess him at 10,000 a year, and another bank will assess him at 80,000 a year. Again, I was given the Intel example as an extreme scenario. When it comes to self-employed, the way the banks look at self-employed varies dramatically. So if you are involved with a self-employed individual in terms of a relationship, and or you know anybody in that space, again, suggest maybe they reach out to us. We do specialize in dealing a lot with contractors and individuals that have their own businesses and making sure that they get over the line. So hopefully everybody found that useful. I appreciate you logging on what is a busy Wednesday and a big day in social media for a number of individuals out there. So we'll see how the day plays out. It won't have any major impact on what we're presenting on here today, but it is entertaining nonetheless. So with that, I'm going to sign off. Dylan has shared actually the presentation. Dylan, I might send you the PDF of this because I did make changes from the last time. So just in case there are some of the information that's on this that's relevant for individuals from the last time. Otherwise, thank you very much, and I hope you all have a great rest of your day. Bye-bye.
Thanks, Mark. Perfect. To add to that, I'll just upload the slides with the recorded version of this video onto our website, so you can download the updated version of the slides there. Thank you very much.